In today's video, we will take a look consumer and producer inflation, Fed rate decision, existing new home sales, and what happened to the first quarter of GDP in 2025. My name is Anna Eckstein, Naples Ultimate Luxury Group, Realty One Group MVP. Let's start. All right, so let's take a look at Fed rate decision. The meeting happened May 7, and of course, the Fed decided not to lower the interest rate at this meeting due to uncertainties of the tariffs and what can lead to this stagflation when the consumer prices going in up, the consumer demand continue suffering, and the prices are high, and unfortunately, it's the worst situation, stagflation, that can happen in our economy or any economy. So we do have quite a few Fed meetings. The next one will be in June 18 and also in July. So you can see we have 5 more meetings and it's on a schedule. So right now we range in the Fed fund rate between 4.25% to 4.5% interest rate. So this is a Fed tool for the market, and this is what they are banking that not very high percentage that Fed actually will lower in June, but there's still probability. And this is the July meeting projection, and this change obviously daily. So this is table. I'm not gonna, you can pause and take a look. This is now from the last meeting. So Federal Reserve do not provide projections every meeting. They do every other meeting. So the next projection will be in June, but I did decided to leave this because it is up to date as far as the accuracy of the projection, what they have. So the 10-year. So the reason why we're talking on this channel about the 10-year is because 10-year is the related to any long-term financing. So like the mortgages. So the mortgages is actually goes from the 10-year yield. So the 10-year goes up, the mortgage interest rate goes up, and vice versa. When the Fed is lowering the rate, actually the Fed is not lowering the rate for the long term. It's a short term rate for the Fed. So the Fed doesn't have a direct, exactly way to lower the actual interest rate. Well, they could do if they could buy bonds, and there's different ways how you can actually get the interest rate lower, right? But one of the rate that actually go for the 30-year mortgage rate, that's goes from the 10-year treasury rate. And you can see that in September, when the Fed actually start cutting the rates, the 10-year, the rate was actually 3.62%, which obviously right now is really high. And as this recording, we have Thursday, it's actually the 10-year close right now trading about 4.37. So it's like about 10 basis points higher from this chart. And this is the lowest that we had, 0.65%. Less than 1% in April of 2020. So if we going into the 10-year, so what is why if the 10-year right now is 4.37, right? And why the mortgage rates is almost 7%? Because of the spread. And as I'm doing this recording, the spread right now is actually, I think I was calculating, is under, it's like 2.47% or so. Just depends on how you calculate, almost 2.5%. And you can see that before 2008 crisis, spread on average was 1.5%. So this is another way how the mortgage rates could go down if the spread will get back to at least some sort of normalcy. You can see that we could actually lower our mortgage rate by 1 point, by 1%, just if the spread would get to some sort of normal levels. And you can see back in 2023, 2024 is about 3%, even in some cases. So right now it's pretty high. So what they're leading? They're leading for the, obviously for the mortgages, the reason why spread is higher because there's more risk involved. Also the liquidity in the market, the prepayments, the cost of regulation, obviously the inflation. And so there's a lot of different factors why the spread sometimes goes higher. Uncertainty, goes higher than normal times, I guess. So the 10-year, where are we at? So today this is as of May 2nd, 2025, we at 6.89% sitting. The mortgage applications jumped by 11%. People say, well, when I need to buy, I need to buy. It's a 10-year mortgage rate sits at 6.76 in the United States. And you can see, actually, I always compare the charts for the highest and for the lowest that we had. The lowest we had in 2020, 2.66%. Lucky whoever purchase or refinance at this rate. I don't think we can see this rate anytime soon, but this is just my 2 cents. The highest we had 18.63, so 7%, high six. It's actually it's pretty average if you look this chart from 1972. So inflation, where are we at? So the target rate for the inflation for the Federal Reserve is 2%. We're sitting right now 2.4. And this is for the March inflation for the 2025. And actually, if you take a look, the highest and the lowest inflation that we had in the United States also, if you take a pause, so like we were totally in this inflation in 2009, we was 23.7% in 1920s. Oh my gosh, you look in some of these numbers, it's just crazy. This is your double top in the 70s and 80s with a Paul Walker. So, and 2008, we actually was 5.4%. So, and 9.1, the highest we had since COVID inflation. So core is excluding volatile items like gas and the food, things like that, energy. So where we at is 2.8. The target again is 2%. So you can see that the highest we were in 2022 was September 6.6%. In the 80s we were in 11.7, 13.6. So it's quite interesting to see sometimes data from the past, so you understand where we are today. So the inflation is definitely coming down. This, if you like, take a pause, break down the by items inflation, where it's rose, where it's declined. So I'm not going to spend too much time on this, but you're welcome, please, to take a look. And producer. So why we pay attention on producer inflation on this channel? Because for producers will be more expensive, guess what? Where it goes to consumer. So it's important to take a look. And again, our inflation is going down 2.7%. Here's your chart of the highest and the lowest that we had in the history. Core is the same concept, minus volatile items. And you can see we're sitting at 3.3%. Now, again, what is the goal? Is 2%. And the highest we had in March 2022, 9.7%. Now, PCE is actually preferred gauge for the inflation for the Federal Reserve, for Mr. Powell. So he is really paying attention on this, and we're getting down is 2.3% on the month of March. And you can see the highest we had in 2022 is 7.2%. So core, it's again excluding volatile items, we at 2.6. And the highest we had is 5.63%. So retail sales, this is the health of the consumer. So we should pay attention on that. So the consumer is still spending 4.6% on the month of March. I don't know if this is preloading before the tariffs. My 2 cents for that, probably yes, but we're still going in. And if we take a look personal income, so the personal income rose by 0.5%. But look at this, guys. The personal spending actually rose by 0.7%. So the spending is definitely there. The initial jobless claims, the reason why I usually don't bring the charts, but I decided to bring it up because as I was watching, there was a lot of all the layoffs that we had. There was a lot of rumors was that we will have a horrible job report. And so I was just keep watching jobless claims and they spike in, this is right before the report for 241,000. But then the report that we had on May 3rd, they actually came down a little bit. So, but I just wanted to kind of to share with you since I was watching. So if we take a look, so the report come up way better than expected, way better. So come up as 177,000 jobs. And it was interesting. So expectation was 130. I was surprised because I was thinking like, wow, with all the firing that we had, and there was a lot of the headline news. I was still created 177,000 jobs. So and you take a look some of the historical data as well. So unemployment rate stayed the same. At 4.2%, and you can see at the COVID unemployment jump to what 14.9%, and some of the you can see it like relatively like if you look in the history, a lot of unemployment relatively low, even at 4.2%, it's still very low. So this is where the jobs created. I'll show to you shortly. There's a little bit better breakdown. I saw online, so I just kind of printed out for you as well. And you can see we created 10,000 government jobs. The manufacturer will lost some of the jobs. And non-farm payroll come in as 167,000 jobs. So where the jobs actually came from. It's interesting because majority of the jobs, the 70,000 jobs actually, guys, came from education, private education and health services. That was quite interesting as we aging. There's a lot of demand for those type of jobs. So that's quite interesting. So average hourly earnings, we have 3.8%. You can see some of the historical records. So where are we at on building permit? And as you're watching this channel, I will upload some local market updates. But let's take a look quickly where we at on nationwide. So in the nationwide, we actually we have the building permits. We have 1,467,000 building permits. This is like a nationwide. And this is some historic data on the lower side. You can see in 2009, we only had 513,000. So it's quite interesting compared to the history where we at on a building permit. That's why I like to reference historic data, because if I just show it to you, yeah, we had the building permits of 1,470,000, right? Yeah, it's nice, but compared to what? Like, this is good, bad? I mean, tell me more. So that's why you always have the historic data so you can compare it to. So housing starts, that's the building in progress. And you can see that we at 1,324,000 on housing starts, and this is historic. And you can see like where we really was frozen in 2009. That's insane. So that's we are new home sales. So the new home sales, we actually 7.4% surge from the previous months, and you can see the existing home selling actually. Not the existing. The new home selling is actually keep increasing, and this is again you can compare to to previous. The pending home sales is actually went down by 0.6% compared to a previous month. And this is interesting. I was looking at this article. I was like, oh, March home. So this is existing home sales. So this is not a new home sale. This is existing home sales. Think about it this way. It's actually dropped to the lowest pace in 2009. So then I'm like, okay, well, let's check on that. And it's actually the lowest. It was, we had even in 2010, even lower home sales at 3,450,000 homes. And you can take a look. We're right now at 4 million range units. This is sold in March for existing home sales. So it wasn't as 2009, it was 2010. So anyway, and you can see at the COVID, gosh, we were 6 million in January 2021, 6,600,000 homes sold. That's quite a big difference. So GDP. So you probably heard on the news that we are in negative quarter, and well, thanks to the tariffs, because it's a lot of companies and the consumer is rushed to pile up on those goods, and that's really what happened. And I will show to you shortly what really create the negative. If we wouldn't pile up on inventory, we would be in a positive growth, but because of the inventory piling up, we went to a minus 0.3 negative. And I will show to you shortly. This is actually one of the, in Washington Post that I found, it was explaining basically the consumption from the private inventories and overall change. That's what happened. And if you look in right here, so you see this the GDP sales advance. Oh, by the way, this is not the final, so that could be a revision, and we can back to revision to positive or who knows. But this is just the advance. It's a first advance. And then we have another one, and then we have a final. So where we at? So you see this is minus 2.5%. That's your inventory. It's basically your inventory. And but the consumer is still spending. The spending advance for the consumer is 1.8, not as strong as the fourth quarter, but still here. And this one is explained, kind of shows a little bit more in detail. This is your 2.5% of those inventories change in private inventory. So that's where we're at. And in gray, it's actually 2024. So if you like, take a pause and compare, so you can see we were here in this territory, and you can see the business investments actually is better in the first quarter of 2025 versus the 2024 consumer spending. You see it's a little bit weakening, so you can just take a look. So that's where we're at. I was just looking. It was kind of interesting. The Apple, so they airlifted. Guys, $2 billion from India in March, those iPhones. So it's a very scary. I shouldn't, smile, but it is a scary what happened, because you just don't know what to expect. We are walking on such a thin line right now. You can go either direction, and we just don't know which direction we can go. So anyway, this is my actually last chart that I would like to share. So the PCE actually came in a little bit hotter than expected for the first quarter, and core PCE also came in a little bit hotter. This is the quarterly, so we did review the monthly. So the quarter is a little bit hotter than expected for the Fed. I hope you enjoyed this video. I hope you find this video valuable for you and for your family. If you do, please don't forget to subscribe to the channel below. My name is Anna Eckstein, Naples Ultimate Luxury Group, Realty One Group, MVP. Thanks so much for watching and see you in the next video.
Baby, you give me ice and fire. You're giving me wings.